So the Fed just cut interest rate this week. And while everybody's debating what it means for inflation or the economy, let's talk about what actually matters to traders and investors. Because when the Fed cuts, the entire market shifts. Some assets will pump, some assets will dump. And if you don't understand how money flows between them, you're basically trading blind. So in this video, I'll break down exactly how this rate cut is rippling through stocks, futures, crypto, bonds, and Forex. And if you stay till the end, I will show you exactly what I added to my $1 million portfolio after the cut and why. Now, bear in mind that this isn't some advice, right? It's just to show you that I actually got real skin in the game. I don't just talk theory, I actually trade what I teach. My name is Brad Goh, and I've been trading for almost 7 years now. This year alone, I've made over $1 million in profits, and I've documented every single thing live on my second channel, Brad Trades. I've also helped hundreds of traders become six-figure funded traders. So, I don't want your money. I want you to become a better trader. And today, I'm going to be breaking down exactly how this rate cut is reshaping every major market and how I'm positioning for what's coming next week. Now, before I talk about how this affects different markets, let's look at what actually happens when the Fed cut rates. When the Fed cut rates, borrowing cost goes down, which means that it's easier and it's cheaper to borrow money from the bank. And this means that businesses can take on more loans, which means that people like you and me can also take more loans as well, which means that we're gonna spend more money. And this extra demand increases the demand for goods and services, which increases the price of goods and services, and in turn boosts inflation. But there's a flip side to this, because when money is cheap, when money is abundant, just like dirt, it becomes worthless, which means that the dollar will start weakening. So this single move of just cutting interest rates, it actually sets off like a chain reaction across every single part of the market. Now, firstly, let's look at stocks, because when interest rates drop, the stock market usually reacts first. And here's why. When you have lower rates, right, lower borrowing costs, this means that companies can refinance debt. This means that they can borrow money to grow or even buy back their own shares. And that pushes their profits and their stock prices higher. And this is also why you see Nasdaq and S&P 500, they often pop off after like an interest rate cut. And usually, technology and growth stocks tends to lead this move, right? Because they are value on future profits. Which means that when money is cheaper, when borrowing cost is low, those future profits are worth so much more today, right? This is why you will see Tesla, Nvidia, Microsoft, Apple, these stocks start popping off. But here's the other side. Sometimes the Fed cuts not because they want growth, but because the economy is already slowing down. And when that happens, investors, they tend to pull money out of risky sectors like the technology stocks and move it into safer places like healthcare, utilities, and consumer staples, which is basically like companies that sell stuff that people need no matter what, no matter whether there's a financial crisis, no matter whether there's a war. I'll give you an example. Back in 2020, when there's the COVID-19 pandemic, the Feds actually slashed rates to zero. And this allowed technology stocks to actually rip at first. But once recession fears start kicking in, money rotated fast into companies like Johnson & Johnson, Procter & Gamble, and Coca-Cola. You know, like the boring, stable companies that Warren Buffett invests in. So the key question here you want to ask yourself isn't, did the Fed cut rates? But why did they cut rate? Because if it's a growth cut, the markets can run hard. If it's a panic cut, you will usually get like a short-term pop just like this, but then weakness right after that. And that's exactly what we saw this week, right? The classic buy the rumor, sell the news move. As you can see right here, on 17 September, 2 p.m. Eastern Time, or 18 September, 2 a.m. my time, the Feds actually announced that they were cutting interest rates by 25 basis points. And when that actually happens, instead of pumping up, right, which we were expecting price to do so, the market actually dumped heavily. And that confused a lot of people, right? Because on paper, when interest rates get cut, it means that price should be bullish, right? But markets don't work that way because the markets move on expectations, not the headlines. Traders have already priced in this move weeks ago, which means they brought the rumor and they sell the news. By the time Jerome Powell got up to speak at around 2 p.m. Eastern Standard Time, everyone who wanted to go for long, they are already in the position. So when the news actually hit, there were no buyers left, just profit taking, which allowed price to actually collapse right after the news get released. And that is why you often hear people say, the markets trade the expectation, not the event. The real edge here isn't reacting to news. It's anticipating how everyone else will react to the news. So if you saw the Nasdaq or Bitcoin drop right after the cut, that's not because it's bearish. It's just traders resetting positions. And the key is what happens next week, once everything resets, once the market takes into account of the new updated information. Now let's talk about why the Fed even cut interest rate in the first place. They're not cutting because the economy is booming. They're cutting because growth is slowing down. Inflation has cooled off. And they're trying to prevent a slowdown from turning into a full-blown recession like what we have in 2008. And if you look at over the past few months, consumer spending has actually dropped. Job opening has actually declined, and banks actually tightened credit, which means that people are spending less money, businesses are hiring less people, and the economy is just losing steam. So by cutting rate, the Fed is trying to make money cheaper to boost borrowing and stimulate spending, and to keep the economy from stalling. But one thing you must understand is that rate cuts do not work overnight. It takes months before that new money flows through the system. So if the market rallies right now, it doesn't mean that the economy is fixed. It just means that investors are hoping that things will stabilize soon. And to be honest, in reality, a rate cut just like this usually means that the Fed is a little bit worried. So if growth continues to slow down and unemployment rises, then this will be a defensive cut rather than a bullish one. But if inflation keeps cooling and growth holds steady, then we could potentially see a soft landing. And that is when risky assets will really start taking off like crazy. Alright, let's move on to the futures market, because that's where this expectation get priced in first before the stock market get a hit. So for futures, you must understand that it's always going to be the first to react to a rate cut or a rate hike. Because when rates drop, traders, they tend to reprice everything from stock futures to bond futures to commodities, and they price the rate cut instantly. So for equity futures like Nasdaq or the S&P, cheaper money means what? Lower borrowing costs. Lower borrowing costs means it costs less for big funds to actually hold long positions, right? So this is where they'll start leveraging more, and you will see a quick spike in price. And then bond futures will also rally, right? Because yields will start dropping, right? We'll talk more about bonds later, but you will know that lower yields make existing bonds more valuable. But here's what catches newer traders. Right after the Fed cut, the volatility usually spikes. Funds tends to rebalance and hedges get adjusted, and price will go wild for like a few hours to a few days. So during the weeks where Fed is actually announcing something, please do not trade based on your emotion, right? Trade based on data. Wait for the dust to settle before you size up again. Like what I mentioned right here, you want to trade the confirmation, not the breakout impulse. So I'll give you an example, right? So this is when the Feds actually cut the interest rates. And then I pretty much waited for price to pull back to the demand zone that led to this imbalance move, that led to this break of structure, which means that that is the institutional price point where there's going to be a lot of buy orders. And once price actually mitigated the point of interest, I waited again, right, for a fractal market shift to confirm to me that the entire pullback is over, right? The entire internal structure is shifting from bearish to bullish. And then that is when I waited for price to pull back to the flip plus sweep zone that created this fractal market shift. Once again, another type of institutional zone. And then I entered for longs right there. And I pretty much made about 77K on this one trade itself. Once again, if you go to my channel, you will see the entire live trade breakdown, how I actually entered from start to the end. So I'm not going to yap too much about this trade, but I think I did pretty damn well on this trade. I literally predicted every single move. All right, so go and check that video out. Now, crypto. This is where things heat up, right? Just as hot as my green tea right here. So when the Fed cut rates, what does it mean? It means that people are going to borrow more money, businesses are going to borrow more money, which means that there is going to be liquidity. And then what investors will do is that they'll start to move out of their safe assets and look for assets which offer higher returns. And crypto sits right at the end of the high risk, high reward spectrum. That is why Bitcoin and Ethereum, they tend to rally right after the interest rate get cut. Because cheap money equal more risk taking, equal higher volatility in the market. But it's not instant. It takes time for liquidity to actually reach the crypto markets. And when that liquidity dries up again, crypto is usually the first to crash. which is why you want to treat it as more of like a momentum play rather than like a safe haven, because it thrives on easy money, but it bleeds when liquidity disappears. So this is where, once again, this red line right here is when the Feds actually cut the interest rates, and you can see price did not go up straight away. In fact, it actually went all the way down here to the 109,000 area, mitigate this demand zone that created this market shift before it started rallying like crazy, right? So if you actually miss this move right here, my man, too bad, because like in the last live trading session I had with my 1% club students, I was telling them that Bitcoin is about to skyrocket. It's just the market doesn't know it yet. And right after I told them that, the market did indeed just rally like crazy, and now we just broke all-time highs. So never doubt Brad Gold, never doubt the Trading Geek. And just like I said earlier, it takes time for liquidity to reach the crypto markets, which is why price did not just go up straight away. Instead, it went down, come down to this demand zone with a lot of liquidity and also some available liquidity that we have on the left-hand side right here. Trigger all the retail stop losses out. And then this is where institutions, they start loading in. And then that is where we got this huge move to the upside. All because of liquidity, right? At this 108,000 level right here. All right, let's move on to bonds. And I know bonds is boring, but it's important for you to understand how it affects bonds, right? Because this is where rate cut hits the hardest. Because bond prices move opposite to use. When the Fed cuts, use actually fall. Bond prices move opposite to use, which means that when the Fed cuts, use fall, which means that the existing bonds paying higher interest becomes much more valuable. And that is exactly why long-term bonds like the 20-year treasuries, or what I call TLT, or that's a symbol, they usually jump right after the cut itself. And to me, when I look at this chart right now, I do feel like it's kind of lagging, right? Because you can see price have not made like a huge move to the upside right after the rate cut. It was just a few weeks leading up to the rate cut as the market price in like the upcoming move. This also means that price is potentially making a pullback right now so that it can fuel the next move to the upside, right? The next leg to the upside. And they can potentially expect price to even come up to this $94 level. Because you must understand that this is where big institutions, they are probably going to start buying bonds right now to lock in those higher yields before they drop even further. But here's the risk. If inflation picks up, yields can rise again, which means long-term bonds just like this is going to fall fast. So bonds are great if inflation stays under control. But if price starts heating up again, you want to be careful. All right, let's move on to commodities. Now, when the Fed cut interest rate, like I said, it pretty much makes the dollar more abundant, which means that the dollar usually weakens. And that's actually good news for commodities, because most commodities are priced in US dollar. So when the dollar drops, they get cheaper for everyone else, which means that the demand for commodities is going to go up. And this is why gold has been rallying like crazy. This is why gold is just at its all-time high right now, and this entire curve just looks absolutely insanely anabolic right now. Gold doesn't pay interest, but when yields are low, people move money into gold for safety, right? It's also like the hedge against inflation. Now, oil is a little bit different, right? Because if traders think that rate cuts will boost economic growth, oil prices tend to go up. But if they think that a slowdown is coming, right, oil prices will drop because there is less demand and there is less need for energy. It's the same thing with copper and industrial metals. If the economy picks up, they will rally. If not, they will lag. So if gold is running crazy just like this, but if you look at the prices of oil is actually going down, this means that the market is quietly saying, we are scared of a slowdown. And you gotta make sure that you listen to what the market is saying, you know? And finally, we got Forex. Now, like I said, when the Fed cut interest rate, US dollar becomes less attractive. It becomes more worthless, which means that currency pairs like EURUSD, GBPUSD, AUDUSD tends to strengthen, tends to go up, right? These are the major currency pairs. Because now traders are moving outside of US dollar and they are investing their money into currencies that pay better returns, right? Just like this Euro, GP, AUD. And at the same time, safe haven currencies like the Swiss franc and the Japanese yen, they can strengthen too, right? Because when growth starts to slow down, big money, they want to hide in safety assets, safety currencies like the Japanese yen and the Swiss franc. So when you hear the Fed cutting interest rate, I want you to think of it as like a global domino effect. Because this is where institutional flow of capital starts shifting every single where. And the dollar usually takes the first hit, followed by the other currencies, followed by the other asset classes. And if you look at EURUSD chart, right after the Feds announced the rate cuts, they did not just go up straight away, right? In fact, it actually collapsed, right? So once again, it ties back to the buy the rumor, sell the news thing. And it collapsed for quite some time until right now prices came all the way down here, almost taking out a 1 hour strong low, but did not do so. And then right now it created a market shift, which signaled that the pullback is over. And right now we have officially shifted bullish. And also you can see we got this very choppy, volatile sort of market conditions. But then later on, price came down, swept all the available liquidity below those lows right there, trigger all the retail trader stop losses who entered for a buy like right here. And now we are getting the market pushing to the upside again, right? So right now I'm pretty much expecting the market to take out this high here, and then eventually it could even take out this high here as the market start taking into account the updated information of price actually shifting bullish. Alright, so if you're still watching this, that means that you are serious about trading or investing. So here's what I personally did after this rate cut. And again, this isn't financial advice. This is a documentary, not a sermon. I'm just showing you that I actually put my money where my mouth is. So at the end of September, I actually bought about $150,000 worth of Bitcoin. Because, like I said earlier, rate cuts bring more liquidity, which means that real use is going to drop and Bitcoin tends to move before the rest of the market catches on. And when I look at gold and I saw gold was actually like breaking all-time highs every single day, I just know that it's only a matter of time until digital gold, which is Bitcoin, break all-time high as well, right? That is why I actually entered for longs right there. So this is not like a short-term flip, it's more of like a conviction play. And I've also added $10,000 worth of long-term treasury bonds, the 20-year treasury bonds, TLT, onto my portfolio as well, right? Because this is more part of like my dollar cost averaging plan. And this brings my total holdings to about $110,000 for the 20-year treasury bonds. Now, for me, this is more of like a long-term macro bet, right? I'm positioning for use to slowly trend lower over time. And also this pays pretty good dividends, right? So that's that. So right now on 6 October 2025, my portfolio is pretty balanced between growth conviction, right? Which is like Bitcoin and some AI stocks, and defensive income, which is like bonds and some ETF. Now, if you want me to break down my entire $1 million portfolio and how I'm scaling it to 10 million, drop a comment right now below and just let me know, right? Because I'm really passionate about this stuff, because this is where I've been investing a lot of my trading profits into, right? Instead of blindly spending my trading profits on sports car or watches, I've just been investing a lot into the stock market and the crypto market. Because right now, my goal is not just to be rich, it's to build wealth. And wealth is defined as having businesses and assets that earn money while you sleep, right? So right now, I'm actually working on scaling this to around $10 million before the age of 30. And I'm sharing every single move on my main Instagram, Brad Go. Like every single trade, every single asset that I buy that is adding into this $1 million portfolio, I'm sharing it on this Instagram account, right? So make sure you follow me if you want to see the full journey. Shameless plug here, but if you go to my Instagram and just click on this highlight right here, you will see every single stock that I've bought, every single asset that I've added into my portfolio since I actually started this entire thing, right? So go and check that out. Alright, so here's a quick summary on everything. How the Fed cuts affect every single asset class out there. For stocks, especially for growth and tech stocks, you should be buying, right? Because this means cheaper borrowing. This means that people are going to be investing their money into more risk-on assets and take on more risk since they have like a larger risk appetite, and that usually means that they're going to be buying stocks like Tesla, Microsoft, Nvidia, Apple, Meta, so on and so forth, right? And for defensive stocks, you want to hold or you want to buy, right? And this is more safe if we know that the Fed is cutting interest rates because of recession fears. And then for futures, you want to buy, because once again, there is fast repricing, right? The traders are taking into account the new updated information, and this is where institutions are going long as well. And then for crypto, same thing, you want to buy, right? Because this is where liquidity is flowing to more high risk assets like Bitcoin, Ethereum, and all the other altcoins is going to be following Bitcoin and Ethereum. And then for bonds, long-term bonds, you want to buy, right? Because use is actually falling, bonds price is actually increasing. And then for gold and silver, buy, because when you got a weaker dollar, right, that means that money is going to be flowing towards what? Risk-on assets, right? assets that is gonna pay you like a higher return on investment than fucking putting your money in a biscuit tin under your bed or putting it in your bank account, right? So next we got oil. Oil depends, right? You should buy if growth outlook improve, and you should sell if the economy starts slowing down, because oil fuels everything. Oil gives energy for electricity, for like fucking everything, right? Like anything for production, for manufacturing, we need oil, right? So oil is very tied into the economy. And then for US dollar, you should sell, okay? US dollar going to shit, lower use, weaker dollar, which means that it doesn't look very attractive anymore, right? It's gotten ugly. And then for more risk-on currencies, right? For Forex traders, Euro, GP, AUD, buy, right? Because this will strengthen against the weaker US dollar. Because the currency pairs with US dollar as the quote currency, which is the second currency in the currency pair, these currency pairs are going to skyrocket, right? Since US dollar is going to go down. So those are the actions that you should be taking on each asset class, right? But like I said, once again, this is not a sermon. This is a documentary. I'm sharing with you what I'm personally going to be doing, right? So this is not financial advice. Always make sure you do your own due diligence. Now, if you've enjoyed this video, you're going to love this free exclusive training where I'll show you exactly how I scaled to 7 figures, right? So go on, click on it right now. And as always, remember, oh fuck, I forgot my quote. As always, remember, you're just one trade away.